Hello everybody, it's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool. I'd like to start out by wishing everybody a happy and prosperous new year. And of course, one way to launch that would be to look for good investments. And with this article titled, "Have these 5 best defense stocks become the best offense?" as the kind of the play on the old football adage that a great defense is the best offense. And this article or this video are also in conjunction with the article I recently authored titled, "Don't Become a Stock Market Victim," because what I want to focus on here are really 2 primary things. First and foremost is the importance of valuation and understanding that valuation is as important or more important than, trying to buy a stock that you think is just a simple good stock. And then the second aspect is the idea of investing in the business and not a stock. And so I'm going to look at 5 well-known defense stocks here, and kind of a corollary to this whole thing is to illustrate that in the long run, it's the business that matters most, because stock prices will eventually track what the business does. And another aspect of that is you can also then, once you kind of understand that notion, you can understand when stocks are reasonably valued, undervalued, or overvalued, and then make intelligent decisions accordingly. So let's start out by taking a fast graph apart here, and let's look at General Dynamics as the first of 5 examples. This orange line is the company's operating earnings growth rate. You can see the company's grown earnings at the rate of about 10.8% per annum since 1998. You can see that growth has been very consistent, a little rocky coming out of the recession, and this was during the period where defense was kind of on the political chopping block. But the point is, if I add monthly closing stock prices to this graph, you can see that the price, first of all, goes where the business goes. Second of all, you can see periods of overvaluation. This orange line represents a theoretical assessment of fair value, or what I like to call a fair value reference. And then you see periods of tremendous undervaluation that existed here and coming out of the Great Recession. These defense stocks, you're going to see this pattern be kind of consistent for all of them. And then we went into this period coming out of the recession as we got into like 2013 here. And then pretty soon General Dynamics became excessively overvalued. Now, I wrote articles talking about Lockheed Martin and General Dynamics and suggesting that I loved the businesses, but I hated the valuation. There's a couple of very important points here, and I'm going to shorten this graph a little bit to try to make this point. If I measured General Dynamics based on stock price action, you can see beginning of the year, the stock was at 203. Through yesterday's close, the stock ended down to 158. That's a 22% negative drop, or a 19.7% annualized return, because it's just slightly little more than a year. And that's really not very good performance in most people's eyes. But on the other hand, if I look at a couple things, if I first of all look at the company's dividend, and this white line is the dividends per share. Now, if I run this long term, you'll notice that this company has a very consistent record of growing their dividend. I can quickly go to the performance results here, and you can see that the dividend has grown at an average of 11.5%, and it's been a very consistent increase in the dividends paid per year. So the company's been a great dividend payer. Last year was no exception. The company increased their dividend from $3.36 through 2017, and then raised it to $3.64. Moreover, I want to focus on the earnings here a little bit. If you look at their earnings per share, went from $9.95 in 2017 to $11.15. That's a 12% increase. This is tremendous performance. Both the dividend and the company's business did extremely well. The only real issue here was overvaluation. And so, the beauty of it is you buy this stock at a fair value. And I'm going to shorten this graph by 1 year here. And actually, I'm going to do it by 2 years. And I want you to notice that the company was reasonably valued at the beginning here, and it ended up right now slightly undervalued based on this, what I would call fair value reference of about 15. If I look at performance, we have a 9.6% growth rate here. The performance, capital appreciation, was about 9%. The company paid, a nice growing dividend. The dividend grew by over 12% during this time frame, and the dividend dwarfed the S&P 500's dividend yield, and the capital appreciation was greater as well. So we end up with a total rate of return that's significantly better than the market, but I also want you to notice that it tracked where the business went. Now, a couple other things that I would like to point out here. Let's look at this period here, which was an extended period of undervaluation where the PEs fluctuated between about 8 and 10. Now, I'm going to put a valuation reference, an additional valuation reference line just to illustrate this and use it for the other examples I'm about to show. So I've gone into additional settings here, and I'm going to add a PE ratio of 10 across this graph so that you can see the new valuation reference that I've added. So if you were looking at the period coming out of the Great Recession, it was a more or less 10 times earnings business, and it stayed that way for a long time. And then, of course, we had a resurgence in earnings, and the stock price rose dramatically. The company paid out dividends to its shareholders and generated some very good capital rates of return. Had you bought this stock when it was undervalued here, in this case, I'm picking a 9.5 PE on May 31st, 2012, and held it through yesterday's close, you'd have averaged over 17% a year. But there's another point that I want to make here, and if you look at this, the stock was clearly overvalued. And if you understand valuation, and this is the key, you won't make the obvious mistake. You would never buy the stock when it was overvalued, even though it had great momentum during this period. But now all of a sudden you could look at this stock and, I think make the logical assumption that it's probably attractively valued now. And if you measure it based on its, normal valuation multiple over this long period of time, the rates of return for the next couple of years investing in this really best defense company could be extraordinary. But what I really want to focus on is how easily you can recognize undervaluation when you focus on the business more than the stock price. So let's move on. Let's go to our next example here, and let's look at LLL Corporation, or L3 Technologies, stock symbol LLL. And once again, another defense stock. We see almost an identical situation as we saw with General Dynamics. Now, I do want you to notice that the operating performance was not very good here, because this is when there was a lot of, again, political discussions of cutting defense spending. And so the company did sell at a discounted valuation, but it was clearly an overreaction. The stock was worth a lot more than it was selling at, and then eventually went up to its fair value. And then, like we saw with General Dynamics, slightly different, it got overvalued. Now, I like the valuation of this stock obviously a lot better, but I might actually still want to wait on L3 Technologies. But again, it's another example of how the business drives the performance of the company as well as the dividends. You can see they started paying a dividend in 2004, and the dividend growth rate has averaged over 17%. That's very common for companies that just start paying dividends. So let's move on. Let's go to our next candidate. Let's look at Lockheed Martin. Lockheed Martin was very similar to what we saw with the other two. You went through this period where you had this kind of 10-ish multiple coming out of the Great Recession. You see consistent growth. You see a very nice dividend record here of growing dividends. And then once again, you see really exceptional performance. And I want to focus on this again. In 2018, this company's stock price fell from $321 a share down to $261 a share. Now I can calculate that for you real quickly. That's approximately an 18% drop. So everyone would say this was a dog in 2018. But in my personal opinion, judging it by its operating performance, the dividend went from $7.40 to $8.20. The earnings went from $13 to $17. That's a 32% gain. In my view, this company had an extraordinary year. So part of the notion of don't be a stock market victim, I knew the stock was overvalued here. It was very clear, especially when you look at the long-term performance. The price goes where the earnings go, and when it does get disconnected, it always reverts to the mean it corrects, whether it's overvalued like it was here, undervalued like it was here, or once again, overvalued like it was here. Valuation is critical, and when you focus more on the business and try to recognize and calculate fair value, you can really make good decisions. Northrop Grumman is another example that I think is really extraordinary. If I look at this idea of low valuation, you can clearly see the price has gone where the company's operating results have gone. 2018 was a spectacular year. Earnings grew by over 40%, and yet, just using an approximation here, the stock performance for last year was down about 25 to 30%. So we had a horrible stock, a fabulous business, and eventually that business results are going to reward shareholders in the long run. Once again, if I look forward and look at forecasting, this company is expected to have a flat year this year, but it would still, if it got back to its normal valuation multiples, would generate, significant rates of return, double-digit rates of return going forward over the next 3 to 5 years. And then last but not least, another defense stock where what Yogi Bear might have called deja vu all over again is another example of how earnings drive market price over the long run. We see clear periods of overvaluation where the stock reverts to the mean. And sometimes it takes a catalyst, like in this particular example back in 1999. I want you to notice the company did have a bad earnings year. The earnings dropped 7% and 38%. And of course, that brought the stock price down from $70 a share down all the way to $17 a share, which is about a 75% drop in value. But what's important about that is it wasn't just a function of overvaluation, it was a function of overvaluation and some weak operating results during that time. But then the company stabilized, and if we look at more recent years, we see that the earnings growth has been exceptional. And once again, we see an extraordinary 2018 on an operating basis, and yet we saw a significantly overvalued stock that, in spite of its great performance, simply reverted to the mean, especially as the market got nervous towards the end of the year last year. So, stock prices are important, obviously, to people. But in the long run, as Ben Graham said, the market is a voting machine in the short run. People vote their shares. This stock had great momentum, and it lasted for 2.5 years, even though it was overvalued. But then when there was a little bit of fear engendered into minds of people and their hearts, based on a lot of the politics we saw and the closing of the government and yada, 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 we saw this, really dramatic drop in stock price, even though the business did great. So my advice is always focus on the business first, recognize the company's valuation, and make your decisions according to what you think about the business and how the market is valuing it at the time. I think all of these defense stocks represent good research candidates that you might either want to watch closely now or begin to do research more thoroughly, because I think there's some really good dividend growth investments within this category. I've put together a portfolio review here for you. You can see in order of the lowest PE ratios. Northrop Grumman has the lowest PE at 13, followed by General Dynamics, Lockheed, Raytheon, and then L3 Technologies. I like a 15 PE, but anything between, let's say, 14 and 17 would be attractive. These companies offer good opportunity going forward. From a dividend yield point of view, you have Northrop and L3 at about just under 2%. That's pretty much in line with the market. Raytheon's above market, General Dynamics is above market, and Lockheed's above market. These are all investment grade companies. Raytheon and General Dynamics both are A+ rated. The others are BBB- plus or just BBB. Anyway, this has been Chuck Harnwell saying thanks for watching. I think right now would be a good time to take a closer look at some of these defense stocks, and you might want to be looking at, especially if you're a dividend growth investor or even a total return investor. Thanks again for watching.